Good afternoon, everybody, and welcome to our latest DFTL webinar, which will be covering recent legal and tax updates in Vietnam. My name is Jack Sheehan. I'm a partner at DFTL and I head the regional tax group. I'm delighted to have with me today some of my colleagues in Vietnam. Some short introductions. First of all, we have Hanh Tran. Han is a partner in our Ho Chi Minh City office and is also the Deputy Managing Director for our practices in Vietnam. And I'm also joined by Kevin Hawkins. Kevin is also a partner in our Ho Chi Minh City office and is heading our renewable energy and energy practice there. On the tax side, I'm joined by Du Nguyen. Zhu is a tax partner based in our Ho Chi Minh City office, and Lan Hua is a Senior Tax Director. So before we move on, we have some small housekeeping rules. At the end of the webinar, there'll be lots of time for questions and answers. If during any of the talks you have any questions that you would like to raise, there is a function you will see at the top of the screen with a question mark. You can post your question there and we will review it and publish it later. And one of our colleagues, one of our experts will be happy to answer that question if they can during the presentation. Moving on, next slide, please, Segalvin. Our first presentation is with Han, and Han will be covering the recent investment law, the Investment Law 2020, and an update on the Investment Law 2020. Over to you, Han.
Sure, thank you, Jack. Good afternoon, everyone. Thank again for your participation today to our DFTL legal and tax update. My name is Hanh, and I'm pleased to share with you today the key update of the Investment Law 2023 and the Enterprises Law 2030. Next slide, please. So just to quick update, the Investment Law 2020 came into effect on the January 2021. At this point in time, we had the decree in March providing implementation to this law. So the first key change of the investment law is on the markets accessed by foreign investors. This market asset by foreign investors introduce the new law introduce a negative risk concept, meaning that the sector in which the foreign investor cannot invest it, and also introduce the conditions to certain sectors or condition to the foreign investors in terms of the ownership, in terms of the restrictions of the form of investments, or the scope of business and investment activities. Next slide, please. The second change brought by the Investment Law 2020 is on the introduction of the national defense and security conditions. These conditions is applicable both for the M&A transactions or for investment projects. Specifically, the M&A transaction, if the target M&A transaction, meaning a foreign investor purchasing capitals in a Vietnamese company in Vietnam. So if the target company is located in a borders or coastal areas, the criteria of national defense and security will be applied before issuing the MA approval. The licensing authority will request opinion from the Ministry of Police and Ministry of Defense. Similarly, on the investment projects, if on the basis of recommendations of the Ministry of Planning and Investments, the Prime Minister can suspend an investment project if it's harm to the security or national defense of Vietnam. Next slide, please. Another change introduced by the Investment Law 2020 is that the criteria of foreign investor, this is very important. Under the previous law, a company 51% or more owned by foreign-owned enterprise will be considered as foreign investor for the purpose of investment activity in Vietnam, and such as the investment procedure in Vietnam. Now, the law on 2020 lowered this foreign threshold to more than 50%. Next slide, please. The investment law also clarifies some, brings some clarification on M&A approvals, meaning the M&A approval for our audience to understand. The M&A approval is the approval for investor to before acquiring capital in a Vietnamese company in Vietnam. So the M&A approval the investment law clarify on when the M&A approval is required. This M&A approval is required specifically regarding the change of the ownership of foreign investor or the change of percentage of foreign ownership. You can see more on the slide the specific percentage that of the holding of the capital for which an M&A approval is required. Next slide, please. The investment law also introduced the possibility for the competent authority of Vietnam to terminate or suspend an investment project on the basis of a sham transactions. For our audience to understand, the sham transaction is understood as a transaction established by the party to hide another transactions. We believe that this change of the investment law is the intention of the authority to tighten the use by foreign investor of the nominee arrangement under the Vietnamese law. Next slide, please. So that the key change. There's another also plenty change on the investment law 2020. However, I just summarize the key change that I mentioned earlier. I would like also to change to share with you on a proposed change to the investment law already. At this point in time, there's discussions. Sorry, next slide, please. So yes. Indeed, at this point in time, even though the investment law is only entered into force on January 2021, the authority is already in the discussion to bring a change to the investment law. This change is specifically related to real estate sector. Indeed, the current law, I mean, the previous law does not, the investment law a bit strict on the criteria of land use for residence development projects. So the proposed change to the investment law 2022 is that the provision on the land use for developing resident housing project will be broader, meaning that category of law of other land use like agriculture, but provided that is approved in the master plan can be used for the for residents housing development projects. Thanks. Next slide, please. So that's it on the investment law. I will present to you quickly on the key chain of the enterprises law. The key chain of the Enterprise Law 2022. Next slide, please. So the first chain is to for the Enterprise Law to enhance the right of the minority shareholder rights by lowering the capital ownership of the minority shareholder to 5%. For to the minority, you know, to share to request the meeting of the board meetings or to cancel a board resolution. This previous law was the minority shareholder must hold at least 10%. Now it's become only 5%. You can see more information in the slide. Next slide, please. Also, the enterprises law bring clarification to the right and obligation of legal representative in case the company had more than one legal representative. Now, the law specifies that if the chapters does not specify the right and obligations of the two or more representative, the owner representative will have equal rights to represent the company and be jointly responsible for any damage go to the companies. Next slide, please. Also, the enterprise remove the requirement on the control boards and controller in case of limited liability. This change is supposed to soften the corporate governance in a limited liability company in case of multi-member limited liability having 11 members, or in case of one-member limited liability company with corporate entity being the owners. This is to soften the corporate governance. Next slide, please. Also, the law enterprise clarifies the right to existing shareholder in case of private placements. The previous law did not really specify the steps that the company must offer. The preemptive right to existing shareholder. The law enterprise 2022 make it much more clearer now, meaning the company had to offer first to existing shareholder in case it issue new share. Next slide, please. Also, the law enterprise clarifies the category of who can purchase the bonds issued by a non-public company. The law enterprise specifies that only strategic investor or professional investor can purchase. The previous law didn't have these requirements. Now the law enterprise does not really provide what does it mean, the strategic investor or professional investor, but for our audience to understand, those definitions are given under the security law of Vietnam, and we expect that will be the degree clarification on this subject will be provided. Next slide, please. So I think that this from the enterprises law and the investment law. I hope that is helpful. I will leave it the.
Thank you for that, Han. And I will just say again, if you've got any questions, please post them in. There's a function at the top of your screen that is for Q&A. You'll see some bubbles with question mark in it, and you can post questions in there, and then Han or Kevin or myself or Du or Lan will be able to hopefully answer those questions for you in the Q&A session. So on to our next session. I'm delighted to welcome Kevin Hawkins, who will be discussing on investing in renewable energy in Vietnam. Kevin?
Okay, thank you, Jack. Thank you, Jack, very much. Appreciate that. And good afternoon, everyone, and welcome to our seminar. I'm Kevin Hawkins, and pleased to be here with you. First slide I'm going to put up here. We recently received, just about over maybe a week ago, the draft version of the Power Development Plan 8, which is the revision of the draft 7, the Power Development Plan 7, which we had prior to this. I can say, first of all, this represents a draft. It was released just over a week ago, and already we know that the government has already requested comments and clarifications from MOIT regarding this draft because it doesn't correspond with the incentives and the other plans that are provided by the government in terms of renewable energy commitments and other aspects of this. So there will be further clarifications likely to this this draft PDP 8 going forward. But this is what we have with us now, which was released. And I think the essential parts of this that I just wanted to go over quickly on this chart, while I put it up here for you to see, is that we can see that there's some significant changes. The significant changes are that we continue a steady commitment to solar and wind energy going forward through up until 2045. Although we see that offshore wind specifically takes a big hit in the near term. We have no offshore wind up until 2030 in this current plan. And in 2030, we only see a modest amount of 2,000 megawatts, with it not ticking up significantly until the 2045 projections, when we see a greater increase in that. We see continuation of the coal to increase in the near term, before it eventually comes down to a decreasing point in 2045. We see a decrease only then in terms of the coal energy power here. We see similar with regards to hydro. We see some decrease over the long term in hydro, but some initial uptick in the near term. We see an increase in reliance on gas, and part of that, a lot of that part of the increase on the thermal gas is the LNG component of that as well. So that's going to be a major portion of the gas increase. And then we see, if you can see down below, while the percentages may not increase that much significantly, you see percentage increases are fairly consistent across different time periods. What you do see from the chart below is that from the period of 2025 to 2045, you see nearly more than doubling of the energy capacity in that amount of time. So while the percentages may not increase, the energy capacity definitely is increasing considerably over the next 20 years. Next slide. Okay, some summary of some of the points I was mentioning is that we have increases in coal. Again, this is an interesting point nowadays because there's a lot of controversy on this. A lot of investors are not investing in coal, and yet we still have a number of projects already on the books, already continuations from PDP 7. But we know that certain European investors, we know that even China recently has stated that they will not invest in coal outside of China anymore. So it's going to be an interesting scenario where we have an increase of coal in the prospectus of the energy matrix, but we're going to have some issues perhaps in terms of the funding of those kind of investments in coal going forward. Then we see a modest addition of wind and solar power, which is not as significant as I think most people were expecting, modest increases there. And what we do see is a removal completely of nuclear power. People may remember in PDP 7 that nuclear power was still in that power development plan. Specifically, there were two plants, the Nintwin 1 and Nintwin 2 plants that were supposed to be going forward in that plan. Those were both canceled in 2016. The government says for economic reasons that the cost of production of the energy there was just too high. But you also may recall that that was also post Fukushima, which was the 2011. So there may have been a number of other issues that were relating to the abandonment, at least now, and in this current plan of nuclear energy going forward. So next slide. So we turn now directly just back to wind specifically. And we see that there's the total onshore and nearshore power from wind is still increasing, although it's a modest increase. It's not really that significant from what we had in PDP 7. So in that sense, it's a bit of a, it's not as significant as we were hoping for, I think, in that respect. And then we know the biggest difference here is that the total offshore wind capacity is only expected to reach 2,000 megawatts by 2030. And that I think has the biggest question for myself and for others on my team as to why there's such a small increase of offshore wind until 2030. Perhaps other people who are on here, and I recognize we have a lot of industry experts on this call, so please, if you have comments, please feel free to enter them in. The draft PDPA does provide for significant offshore wind increases in the up to the 2045 period, significant portion of that. And so all types of onshore and offshore wind will be significantly increased by the 2045 goals in there. Next slide, please. So where are we going now? Ongoing wind power projects right now. as most of the industry people who are on here know, next week or actually the end of this week is the end of the FIT period for wind power. October 31 is the expiration date, and as of November 1, it's supposed to be moving towards an auction of some kind, but we don't have any regulations in place. A lot of several provinces had petitioned, and a number of investors had petitioned to get an extension of the FIT for wind beyond the October deadline. And from what we understand from discussions and announcements by MOIT personnel, there will not be an extension of the FIT. There were recommendations for 3 to 6 months, but so far we're not hearing any commitment to extend that period, with the emphasis being that it should move to an auction system similar to solar. We still don't have regulations for either. So as of November 1, it's very unclear as to what the situation will be for both wind and solar going forward after that period. We still are looking for these regulations and hoping that they are released at some point soon. Okay, next slide. So I'll move on to the solar update and in terms of the FIT and auction. And actually I want to start with the second point first here, because here we talked about the MOIT has been in the process of finalizing the framework for the FIT auction since earlier this year, since 2020, but they released a draft in February of this year of what they expected the auction to entail. And from there, we still have not had any definitive regulations that we can use to rely upon to go forward for these. And we checked yesterday, and even that, we understand that EVN is still even currently holding payments to energy providers because there hasn't been any FIT in place and there's no auction system in place. So right now, EVN is actually still holding payments that need to be paid out. The issues there are rather complicated in terms of the legal requirements behind the FIT process being replaced by auction, because there needs to be a legal basis for this. And I know that they've been considering different laws and to put it under either the PPP law, the tendering law, or the investment law. There's also been a push that the MOIT could simply issue guidelines on its own, irrespective of the other laws that are in place. More than likely, it'll end up somewhere sitting underneath the investment law at some point, but for now, there's still a process going on for that. The point above that, in terms of the August 21, that relates more to the rooftop solar projects in terms of the consideration of the MOIT looking at really the rooftops for residential homes as being ones that should nearly need to be for self-consumption rather than for inputting and exporting energy into the grid. So they're looking at setting up some sort of rates that can be revised every 2 years or so based on market rates in terms of how to regulate rooftop solar projects for individual consumers. That's not the same for industrial parks. Industrial parks there's still guidelines that they're expecting to release for industrial parks use, and also for generation from solar rooftop projects that are exported totally to EVN, and that will be on the current next slide, please. Next slide. Yeah. Okay. So for rooftop projects, here's where we get into some issues here, and this gets into, we have some of the investigations in terms of the rooftop projects. People may be aware, if they're in the industry, that many investors were either adding capacity after the FIT expiration date of December 31, 2020. Other people were who had rooftop projects were just really not real rooftop facilities, but many Vietnamese investors realized that if they raised the ground-based solar projects to a higher elevation and called them rooftop, they could get a higher FIT rate. So you had a lot of weird contraptions and constructions of what were considered rooftop facilities that were not really rooftops, and trying to take advantage of this. MIT launched an investigation. They were supposed to provide results as of October 15 in terms of all of the offending investors. In regards to that, we still haven't seen the results of their investigation yet. At the bottom, we talk about the, again, the FIT will be replaced, and there's supposed to be some sort of an auction program for generating rooftop generating facilities that are generating electricity for the grid. We'll be expected to put that into the auction process as well. Now, for industrial parks, it becomes a separate issue. There's another issue there, and I know Hans knows about this issue, is that you're allowed to set up your own in the industrial parks. You can have your own PPA and you can have your own your own rates. You can set all those rates, provided you're not connected to the EVN grid. And now that's always become an issue recently, and this is what is connection to the EVN grid, because even if you're using the grid within your industrial park and you're selling to everyone there, most industrial parks are still at some point connected to the grid for backup power or reserve, even when they're not generating power. So that until that issue is clarified, there's still some concerns about that, and we still have some guidelines coming forward with regards to industrial parks. Okay, next slide, please. So many people were interested in the DPPA here. This is direct power purchase agreement, and this is under a pilot program. This is not the rooftop. This is a direct power purchase agreement. The pilot program is expected to have a total of 1,000 megawatts, and you have to have 30 megawatts in generation in place within 270 days, COD within 270 days after being selected to participate in this pilot program. The pilot lasts for about 1 year. You will sign contracts, obviously, for PPAs for 20 years under contract for differences and for PPAs, but the pilot program itself will be analyzed after 1 year to develop further guidelines and clarify some of the procedures and applications going on. But there are certain requirements. Again, it's a pilot program. Still, we don't have defining regulations on this. We expect it to be put into place sometime this year, but it's also delayed from what we understand. Next slide, please. We talk a little bit about alternative renewable options here. It's a very small percentage of the energy matrix, but we talk about biofuel and small hydro and biogas as well. And we see that there's small increases in the PDPA plan going forward. Nothing rather significant in terms of that until 2045. We have a little bit of an uptick. In terms of the small hydro, though, we actually see in the period after 2030, we see a very small increase in hydro, only 100 megawatts until we get back up to the 2045 mark. Again, we still need to get some clarifications on why there's such a reduction between 2025 and 2030 in terms of small hydro, but that's still one of the questions we need to answer in regards to the new power plant. Next slide. And just a little talk about LNG. It really is a bridge between fossil renewables. In terms of the LNG, long term, it has a lot of issues. I mean, we have spot market costs for LNG. We have the shipping issues with LNG. We also have the construction of the terminal ports that we need to have for LNG. So there's a lot of infrastructure development, a lot of shipping issues and pricing issues that go around LNG to make it a very reliable and consistent energy source. But yet we see it as a larger component of the gas component structure going forward in terms of the makeup for Vietnam up and through 2045. And we know that there are certain conversions of plants. We know that coal plants that are traditionally been set aside for coal are looking to convert into LNG gasification gas facilities. We also know that when we get back to the nuclear, the Ninh Thuan 1 and Ninh Thuan 2, the People's Committee there has petitioned for that 4,600 megawatts to also be converted into an LNG gas plant as well. So there's a lot of the conversion of existing plants into LNG facilities to make use of that going forward instead of coal. So we know that those are the issues. And so we can see that in about from now until about 2025, we see an increase of about 25%. LNG is only about 25% increase. But then when we see 2045, 2030, LNG is around 50% of the total gas makeup in terms of the component for electricity for Vietnam at that point. Next slide. And I think that's it for me. And I'll be back for question and answers later on. Thank you. Okay,
thank you, Kevin. And very interesting update on what's happening in the renewable energy sector in Vietnam. Again, if anybody has any questions, for anything we've discussed so far, please do feel free to post them in the question section. You'll see at the top of your screen, and then we will deal with those questions in the Q&A session. So we'll move on to our next topic, which is around the tax considerations of cross-border intercompany transactions in Vietnam. Next slide, please, Sigalene. So what we mean with this is that if you're doing business in Vietnam, you've got a subsidiary in Vietnam, or you've a related party in Vietnam, and you're transacting with Vietnam in any way. For example, you may have intercompany loans where a parent company will provide a loan to a Vietnamese subsidiary, or you may have some form of royalty payment which may be made from Vietnam for the use of intellectual property to a foreign related party company. Or you may be providing services of some kind from a foreign company to a Vietnamese subsidiary or related party. Or you may have management fees whereby your head office company may be charging some management fees to the project or subsidiary you have in Vietnam. And what happens here is that related party transactions will give rise to a series of particular issues, from particular tax issues to particular transfer pricing issues, and also possibly looking at double tax treaty issues. So there's quite a few things that you need to be aware of if you're going to have, or if you do have, intercompany transactions in Vietnam. And next slide, please. So Lan, I think you can explain to our attendees today on the key tax issues that businesses face regarding intercompany transactions in Vietnam. Sorry, Lan, you're on mute.
Sorry. Thank you, Jack. Hello, everyone. I'm Lan, and I'm happy to be joining the webinar today. So the first tax consideration that we will be considering for intercompany transaction will be corporate income tax. And why? Because when a company in Vietnam make a payment for the charge of intercompany transaction, then the first question we would ask would be whether the expense can be deductible for corporate income tax in Vietnam. Before we go into details of the tax impact, let me give you a quick review of the corporate income tax rules in Vietnam. In Vietnam, we have the corporate income tax laws issued in 2013, and then we have the decree providing the guidance, and the next level is the circular providing implementation guidance and examples. From 2013 up to now, it's been 8 years. There have been quite a lot of amendments. So the important thing I would like to note is when we look at a provision or we determine tax treatment, we should look at the latest amended provision in the regulation. Also for corporate income tax, for tax administration, we will look at the law on tax administration. And there's a decree recently issued last year on tax administration. Next slide, please. For corporate income tax, in order to be deductible, the expenses must meet the 4 basic requirements in the regulation. The first one is the expenses are incurred and directly related to the business activity of the Vietnam company. For instance, entertainment expenses are generally not considered as related to business activities of the company and are non-deductible. The second one are about the supporting documents, invoices, contracts. For example, if a payment is made without the support of a proper invoice, or it doesn't have an invoice, instead a debit note, or the invoice lacks of key information like tax code or the address or the name is not correct, then the company may be at risk of not getting that expense deductible. The third condition is the expense must be not listed in the list of non-deductible expenses in the regulation. You know, in the corporate income tax circular, there's a list of non-deductible items, about 78 items, setting out the guidance of non-deduction of certain expenses. For example, some penalties, some donations, some expenses exceeding the regulated cap or limit. The fourth one would be about how the payment is made. So the payment must be made via banking system if the expense is over 20 million Vietnam dong. It's about 850 US dollar. And so those are the key 4 criteria for an expense to be deductible. It's very important to make a note here that the Vietnamese company, not the tax authority, has the responsibility to prove the deduction of the expense. So the supporting documents are essential in Vietnam. Next slide, please. Now we will discuss some typical types of intercompany transactions where we normally see the risk of non-deductible in Vietnam. The first one is about the loan interest payment from Vietnam to overseas. As you can see in the slide, in the flow chart, the Vietnam subsidiary has a shareholder loan with its parents. They sign a loan agreement, and the Vietnam company make payment of loan interest to the parent company. So the first risk that we see, and is regulated in the regulation, is that the loan must be related to the income generating activities of the company, and the interest rate must be at market rate. For example, if the rate is higher than market, then the interest may not be deductible. Another risk is about the cap regulated in the regulation. The existing cap on interest expense deduction is at 30% of EBITDA. EBITDA means earning before interest, tax, depreciation, and amortization. This provision is actually provided in the transfer pricing regulation, but the impact is on the deduction of the interest expense for corporate income tax. And this cap will be applicable to both related loans and third-party loan. So if the interest expense in a year exceed the cap of 30%, then the exceeding interest expense will become non-deductible, and that non-deductible expense can be carried forward with to the following year for a maximum of 5 years, similar as the loss carry forward. Another risk which is relevant to new establishment is that if the company hasn't contributed the charter capital following the registered capital contribution schedule of the company, then the amount of loan corresponding to the not yet contributed charter capital, the company cannot get deduction of the interest corresponding to that loan. Next slide, please. The other typical intercompany transaction that we normally see challenged by the tax authority is about the management fees or payment from a Vietnamese company to a related foreign company. the tax authority, normally when they do tax audit, they usually require the company to prove the what we call a specific and direct economic benefit test for the charges for the fees the Vietnamese company pay to its foreign related party. And because there's no clear guidance in the regulation and there's not many precedents in this particular area, it's really subjected to justify the supporting documents and prove the test. So if the Vietnamese company cannot prove and cannot pass the specific and direct economic benefit test, the fee, the management fee, can be non-deductible. Generally, for the cases that the Vietnamese company fails to justify the expenses, we normally see the general view of the tax department is that the subsidiary in Vietnam is a separate legal entity, and it has its own function in management, legal, HR, finance, marketing. That's why the tax authority normally say it does not need to have management services provided by the related foreign company to the Vietnamese subsidiary. So it's important to have supporting documents to justify this type of expense. In our experience, supporting documents are normally seen to include service agreement, written record of meetings, calls, conference calls, emails, and especially when the fee is charged to Vietnam on an allocation basis, it's better to have the supporting documents like timesheet to support the basis of the allocation. Next slide, please. Okay, so the other consideration for intercompany transaction would be the foreign contractor tax or withholding tax. We can call it foreign contractor tax, FCT, or withholding tax. The provision of the withholding tax is in a circular, but here we mention about corporate income tax and value-added tax as well, because the foreign contractor tax includes two portions: corporate income tax and value-added tax. Next slide, please. In general, Vietnam's source income of a foreign supplier from providing services or goods to a Vietnamese company is taxed in Vietnam under this FCT regime. And the two portions, as we just mentioned, value-added tax and corporate income tax. The regulation provides three methods for the declaration of this type of tax. The first method is the deemed method or the withholding method. Under this method, the tax is calculated based on the deemed tax rate on the gross revenue without any deduction of expenses or credit of the input VAT. The second method for the declaration is the deduction method, in which the foreign supplier will register to pay the tax in Vietnam as a local company. And the third method is the hybrid method, which is a combination of the deemed method for corporate income tax and the deduction method for value-added tax. So the most common we've seen so far is the deemed method. Under this method, the Vietnamese company will withhold the tax, make declaration, and pay the tax to the tax authority on behalf of the foreign supplier. Next slide, please. So for the deemed method, what are the tax rates? As you can see in the table, For services, the tax rate would be 5% for VAT and 5% for corporate income tax. For interest, the VAT portion is exempt. Corporate income tax will be taxed at 5%. For royalties, the corporate income tax is 10%. And for most royalty, the VAT is exempt. The 5% VAT on royalty may be applicable to certain cases for trademark or transfer of the right to use of IP. IP means intellectual property. For dividend, it's important to note that Vietnam do not have withholding tax on dividend. So for a tax structuring consideration, it's important to look at this non-withholding tax dividend. For the tax treaty, Vietnam has almost 80 tax treaties signed and effect with other countries, including many European countries, Thailand, Hong Kong, Singapore. Generally, the withholding tax rates under the local rules, you can see in the table, for interest, for royalty, and exempt for dividend, they are already good. So generally, the tax treaty do not provide benefits to this, but for services, for services, in general, Article 7 of the business profit of the tax treaty may provide an exemption of the corporate income tax portion if the foreign supplier can prove that they don't have a permanent establishment in Vietnam. And another important note is that tax treaty relief is not automatic in Vietnam. The taxpayer either can apply for a tax exempt upfront or paying tax and seeking a refund later. But for both procedures, submission of the forms and supporting documents are required to be made to the local tax authorities. These are the key points of foreign contractor tax. The next section would be on transfer pricing. Next slide, please. Over to you, Mr. Yu.
Thank you, Lan. Good afternoon, everybody. I'm Yu Nguyen from DFDL Ho Chi Minh City. Continuing with the discussion on intercompany transaction, I would like to introduce a view at the TP impact to the intercompany transaction. The purpose of this discussion focuses on the TP compliance issue, and we will not go into detailed analysis of regulation. As you may be aware of, the current applicable rules for TP are included in the relevant regulation of corporate income tax, tax administration, and the transfer pricing rule as well. And namely, the Law 32 on 19 June 2013 on corporate income tax, and Law 38 on tax administration. We have a Decree 126, the further guidance on tax administration, and Decree 218 on corporate income tax, and special rule on Decree 132 on transfer pricing, effective on 20 December 20. Yep. For this discussion, we will go with the 5 parts. The first, the common practice. The second, the TP compliance requirement by the law. And the third part, we will discuss on a tax and TP audit with assessment by the tax authority. The next, the risk assessment with the documentation and some tax note away. Thank you. Next slide, please. Yep. Let's go with the common approaches by entity and potential issue. My observation of practical case of documents substantiated for intercompany transaction, which are recorded and maintained at the entity in Vietnam. First, the intercompany transactions are not documented properly or are documented by simplified agreement with only clauses on payment and not clearly defining the scope of work. For example, one-page agreement with a general scope of the supporting service and a cost chart around 2,000 per month. There are no other clauses. The other case, the payments is substantiated by debit note and not by invoices. This case happen with no agreement in place, just debit note for payment. Agreement are only email or other correspondence. The other case, the main purpose of transaction are not clear in agreement. For example, an agreement just indicated of the payment of some $1,000 without detailed scope, deliverable to show the benefit. Or the other case, the basic for the intercompany transaction are not clearly provided. An example is an agreement with the scope of the supporting sale from the two related parties, but no indication of the volume target revenue to be achieved, how to compute the payment bonus. This may be correct for a commercial way, but for a tax documentation, they should look at the legal document binding for the both parties, meaning that it should proper presentation, right format, right show the right and obligation of the party, details work, deliverable, and should be signed off by legally authorized signatory. The tax auditor frequently look at a transaction with improper document substantiated for intercompany transaction. The above case trigger query from the tax auditor, and most of case the tax auditor they deny the document like I just tell you. Please come to the next part. Next slide, please. We go with the TP compliant requirement by law, how and what and when you need to do under law. With over 15 years of TP rule development from 2005 until 2020, from Circular 117 for first 5 years, Circular 66 for another 5 years, and Decree 20 and its amendment, Decree 2068 and Circular 41 in the 2017 until the new one issued Decree 132. And obviously, the Decree 132 is a new document, the new regulation puts up more the pressure on documentation to be prepared by entity, and these are highlighted requirement of what submit, when to submit, and how to present. The rule require complex document substantiated for the intercompany transaction than ever before. First, what to submit? Firstly, the TP declaration form for intercompany transaction between related parties. Second, TP documentation include the local level local file, ultimate parent level master file, and country report. And lastly, the supporting document for intercompany transaction include the agreement and invoice. And when to submit, the TP form is submitted together with the annual CIT return, mean that within 90 days from the last day of the fiscal year, TP documentation report, master file, country reports must be prepared before the submission date of the annual CIT return. What does it mean? It means that they need to be submitted. They need to be prepared together with the TP form. This is a compliant requirement. This is a new one from. This is a new requirement from the Decree 132. And TP documentation and the other document, master file, country report, supporting document must be submitted within 10 working days upon the request by the tax authority during a tax audit. Further information for your reference, how the TP regulation enable and enforce the TP compliant requirement. They provided the broadened right for the tax authority to impose the tax payable, to impose the the taxable income, to impose the profit ratio, impose the allocate rate, and they can impose the pricing of transaction as well. And beside 4 conditions of the corporate income tax for tax deductible expense, the Decree 132 provides some other specific requirement for tax deductible expense for intercompany transaction between related party. Especially Decree 132 requires the TP form need to be well prepared with the key information of the transaction and TP method to determine the price of arm's length. And the TP documentation report requires more information of business in Vietnam. Business function in value change, the way to set the price and the method by the parent company. Yep, thank you. Next slide, please. And how the tax authority, they assess the TP compliance during the tax and TP audit, TP consequences. And firstly, the tax authority can emphasize on the legitimacy of intercompany agreement for compliance with the law of Vietnam. They require the agreement should have complied with the commercial law, specifically with sufficient clause under the form. TP form and TP documentation must reflect the cost versus benefit of the intercompany transaction connected with the supporting document, and they should show the transparency of transaction, the purpose of transaction, cost computation, and appropriate TP method. And if the TPD is not prepared properly, the tax authority may use their own internal database for benchmarking intercompany transaction. This database, they develop it for years during the tax audit. This may be difficult at a time. It may be difficult to convince the tax authority to use the taxpayer TPD anymore. And the result with the TP adjustment by tax authority can reduce the tax deduction or increase taxable income and have a penalty for wrong declaration and late payment. The penalty are very severe and have a very huge financial impact to the enterprise, because it's up to 20% of understatement of tax and beside the tax collection. Yeah. Next slide, please. And what is the important and how we assess the risk for TP consideration on the documentation. Firstly, the TP form. The TP form is the first document the tax authority look at and get most attention to, and they focus on this form to understand and assess how it's connected with the TP documentation report. For TP documentation and supporting document, especially the agreement, is a key important document to decide whether the tax authority accept the intercompany transaction on an arm's length basis. Master file and country report are for reference, and they use it just for the further investigation, and they cannot impose the tax payable for the enterprise, for the company. Yep. The last one, please, next slide, please. And how to control, how to mitigate the risk related to TP compliance. And I have some takeaway notes for you. First of all, a priority 4 conditions will be met for tax deduction. Expenses are related to the business, have a legitimate invoices and contract, payment of 20 million Vietnam dong need to be through a bank, and expenses are not included in the list of the non-deductible expense. Second, related party condition and reporting. test of condition of relationship to see if they are related party is very important, because the M&A frequently happen, and how to assess the related party. And then with the related party and TP reporting requirement should be correspondent. You can refer to Article 5 and 19 of the Decree 132 for further information. Third, TP form, TP documentation, agreement, and supporting document. They should be consistent. Consistency between the TP form and the TP documentation very important. The properly prepared agreement and supporting document should be in place. And lastly, the planning activity. Planning for tax implication of intercompany transaction. For benchmarking and TP form and documentation are recommended. That's all for our presentation today. I hope that our presentation will provide with the useful information for you, and we may come back with a Q&A for some minute. Thank you very much.
Okay, thank you, Drew. Thank you, Lan. Yeah, I think tax is one of those technical areas that business people need to pay attention to, because it's you can end up in a tax audit in Vietnam, and the penalties can be quite severe if you don't manage the compliance. But often it's the case with some planning, you may find that you're actually able to save on taxes and mitigate or optimize your tax position with some basic planning around, particularly around intercompany transactions. You may find that, for example, there may be an exemption from some of the taxes that Lan mentioned earlier by through a double tax agreement that Vietnam has with another country, and we see this regularly. And sometimes business people are not aware, or executives are not aware, company executives, that such an exemption is actually there. So it's always worth paying some attention to your taxes in Vietnam. Now, moving on to the Q&A, we've got quite a lot of questions that we've received. If you've got any questions, please at this time feel free to post them into the. You'll see the Q&A icon at the top of the screen, and you can put your questions in there, and either Han or Kevin or Lan or Sue will try and answer them. So moving over to the questions, the first question that came in was, I am a foreign investor investing in the retail business in Vietnam. Is there any foreign ownership restriction, and is there any other conditions? I guess that's one for you, Han.
Yes, hi everyone again. Thanks, Jack. That is exactly the question for me. So yes, I hear the question that is that in the retail business in Vietnam. So first on the restrictions, I can confirm that there is no foreign ownership restriction for investors to investing in this sector. So you can own 100% a company operating in retail sector in Vietnam. In terms of the condition to carry out business, yet there is conditions. Retail business is conditional business in Vietnam. In order for you to do a retailing business as a foreign investor, you need to apply after the acquisition. You need to apply for a specific business license to conduct this activity. If you open a retail outlet, generally you will have also to apply for an outlet license. I hope that was a response to the questions asked us.
Okay, thank you, Han. The next question that came in was, there was no mention of battery storage in the power plan. How might battery storage be integrated into renewable energy projects like solar? I guess that has to be you, Kevin.
I think that is. Hi, Jack. Thank you. Yeah, I think that's in my alley, right? So battery storage is a bit of a disruptor, right? Because no doubt that the authorities are considering how to integrate this into the plans, because as you know, the solar operates during the daytime, but at nighttime there's no solar power. So battery storage seems to be the real interesting feature of solar, is that you're producing, you store it, and then you can continue sending power into the grid even at nighttime beyond your solar radiation period. We expect, I mean, solar battery power, the battery storage units have been coming down in price considerably. They've been getting better, perfected, the technology is better. And so it's likely that this is going to be implemented at some point soon. The issue right now for solar power developers is that the PPA doesn't recognize battery storage power. So you enter into a solar PPA, you're selling solar power into the grid. You're not selling battery power. So the power purchase agreement needs to be modified to account for selling battery stored power into the grid as well. And what rate that's going to be at and how that will be bid in an auction system are still issues that need to be developed. But no doubt we are going to see battery storage as a component going forward. Thank you.
Okay, thank you, Kevin. We've got a question from Tued Hoang, and the question is, for a reimbursement payment to a mother company, okay, to a parent company, do I have to pay the foreign contractors tax? If not, what supporting documents do I have to show to the tax authorities? Lan?
Yes, I'm here.
So what's your thoughts on Tuet's question? The reimbursement payment to the mother company and foreign contractor tax.
I guess the question is about reimbursements at cost of expenses incurred by the mother company, and the mother company reaches out to Vietnam for a reimbursement, right? Actually, this is a gray area because the Vietnamese tax regulation do not provide a clear guidance on the withholding tax treatment of these reimbursements of expenses at cost. So recently we have seen a number of cases being challenged by the tax authority, and they've sought to apply withholding tax for the reimbursement, if there grounds for them to see that the reimbursement is actually a provision of service from the parent company to the Vietnamese company. And I guess the tax treatment would also depend on how on what kind of reimbursements and how the expenses reach us to Vietnam. So the first condition would be there should be no markup on the reimbursement, right? It must be at cost. And then depending on the type of reimbursement, the type of expense, I guess the Vietnamese company need to have proper arguments and supporting documents to support the fact that is it actually a reimbursement? Is it actually a recharge of the dollar-to-dollar amount of the expense incurred by the parents company? But as I just said, this is still a gray area in Vietnam, so there's no clear answer whether the withholding tax will or will not apply. It depends on how you substantiate the expense.
So I guess on that one, Lan, just to add on to it, if it was deemed to be maybe a type of service fee coming from a country, say that Vietnam has a double tax agreement with, say Singapore or France or China or Hong Kong or many countries, I think there's 80 or so countries, there's a possibility, correct, that the withholding tax, the corporate income tax, may be exempt? Yeah,
exactly. If the foreign company, if the parent company can prove that it doesn't have a permanent establishment in Vietnam, and if it used the tax treaty benefit under the applicable treaty.
Okay, thank you, Lan.
Welcome.
The next question is, okay, regarding the deductibility, so it's a similar question, of intercompany charges, is it a requirement that the payment must first be subjected to the withholding tax. So, so in order to get a deduction in my corporate income tax return, do I have to withhold tax beforehand? Zhu, can you answer this question? You're on mute, Zhu.
Yeah. All right. It's just for the withholding tax and reporting and requirement how to declare it. It should be related to the transaction. If the payment happen, so the obligation for the withholding tax need to be done. And if without any the payment, even they may have a right obligation happen. The tax obligation for the withholding tax obligation have not yet triggered. That you do not need to withhold before the payment.
Sorry, so I think the question is that do you have to withhold the tax in order to get the corporate income tax deduction?
To get the corporate income tax deduction is more related to the condition for the corporate income tax deduction under the regulation. It's not because of withholding tax happen. Yeah. And we can see that the four conditions they set out under the corporate income tax are very clear.
Yeah. Okay. So the rules around deductibility when you're calculating your profits or corporate tax are the rules about it's related to the business, you've got the documentation, etc. The rules about withholding tax, and it's a withholding of somebody else's tax. It's the foreign provider of services or whoever it may be. So there are two separate issues, I think, is to answer that question. We can take another few questions, and I've got one here. If I am a foreign investor, I buy 100% of the charter capital of a target company already owned 100% by a foreign investor. Do I need an M&A approval? M&A, Han, can you answer this question?
Sure. Thanks, Jack. This is a new point of the investment law 2020. In the previous law, if you buy in that situation, you will indeed need an MA approvals. Under this investment law of 2020, you do not need, as a foreigner, if you buy a company that already 100% owned by a foreigners, you do not need to apply for an MA approval. However, if the target company is located in a border area or in coastal area, which is you will fall under the national security criteria, and in that case, you will have to apply for an MA approval.
Okay, very clear. Thank you, Han. I think we may have time for one more. So Vietnam and other countries stress the importance of decreasing reliance on fossil fuels, yet the power plant shows no reductions in coal power until 2045. What factors may explain this? It's a very good question, actually. And Kevin, can you answer this? Sorry, you're on mute, Kevin.
Okay, yeah, sure. Thanks, Jack. Good question, and in topical as well, because the issue really here primarily is going to be one of cost. Coal still is the least expensive of the energy sources that we have available in Vietnam, and we also have a number of coal projects that have been already in the plans and in the works for many years. So it's a carryover from PDP 7 that we have approved projects in the coal sector. It's also a function of the economics in terms of the coal pricing, and really the lack of development in the renewable energy sector, because in the renewable energy sector we still have curtailment because it's too concentrated in the center of Vietnam, in the Ninh Thuan and Binh Thuan province, and so there's an over concentration of renewable within that area, and it overloads the grid. Whereas coal is more throughout the whole geography of Vietnam, and doesn't overload the grid in certain substation areas where it's at. So that's a function of that as well. We see this also, as you may know, China just, while it's not investing in coal offshore in outside of China, it is ramping up quickly its production of coal within China to meet electricity demands. So because of that reason, Vietnam is also looking at ramping up coal in terms of its demand for energy in the near term, but eventually looking at increasing with renewable sources and other sources to reduce coal eventually over time to meet commitments, especially with climate change commitments as well. Thank you.
Okay, good answer, Kevin. Actually, quite a hot and topical subject at the minute. So we have some other questions that we can't answer here today because we would need to. It would take some time. So for any questions that we did not answer directly in the Q&A today, we will contact you either by email and let you know our thoughts or comments on that. So I'd like to thank my colleagues, Han, Kevin, Lan and Zhu for their time today. I'd like to thank everyone for joining us. If you've got any other ideas that you would like us to cover in future webinars, any legal topics or tax topics, please do feel free to send them through. We're always happy to try and accommodate our clients in any way we can. And I wish everybody a nice evening and rest of the week. Okay, thank you. Bye-bye.